An equity fund, also known as a stock fund or a mutual fund, is a type of investment fund that primarily invests in stocks or equity securities. It pools money from multiple investors to create a diversified portfolio of stocks. The main objective of an equity fund is to generate capital appreciation over the long term by investing in companies that have the potential for growth. Equity funds are managed by professional fund managers who make investment decisions on behalf of the investors. These fund managers conduct extensive research and analysis to identify companies with strong growth prospects and undervalued stocks. They aim to build a portfolio that balances risk and return while aligning with the fund's investment strategy and objectives. The structure of an equity fund allows individual investors to gain exposure to a wide range of stocks, even if they do not have the time, expertise, or capital to invest directly in the stock market. By pooling their resources with other investors, they can enjoy the benefits of diversification and professional management. Equity funds can be classified into various categories based on their investment approach, sector focus, market capitalization, geographic location, or investment style. Let's explore some common types of equity funds. Growth funds. These funds invest in companies with high growth potential. They seek out companies that are expected to grow at an above-average rate compared to the overall market. Growth funds typically invest in sectors such as technology, healthcare, or consumer goods, which are known for their potential for rapid expansion. Value funds. Value funds focus on companies that are considered undervalued by the market. The fund managers look for stocks that are trading at a lower price relative to their intrinsic value. These funds typically invest in mature companies that may be temporarily out of favor or facing challenges but have the potential for a turnaround. Large cap funds. Large cap funds invest in stocks of large, well-established companies with a significant market capitalization. These companies are typically leaders in their respective industries and have a stable track record. Large cap funds tend to offer stability and lower volatility compared to funds that invest in smaller companies. Small cap funds. Small cap funds invest in stocks of smaller companies with a lower market capitalization. These companies often have higher growth potential but may also carry more risk. Small cap funds are known for their potential to deliver higher returns, although they can be more volatile compared to large cap funds. Sector funds. Sector funds concentrate their investments in a specific sector or industry, such as technology, healthcare, energy, or financial services. These funds allow investors to focus on a particular sector that they believe will outperform the broader market. Sector funds can offer the potential for higher returns, but they also carry the risk of sector-specific volatility. Index funds. Index funds aim to replicate the performance of a specific stock market index, such as the S&P 500 or the FTSE 100, instead of actively selecting individual stocks. Index funds hold a diversified portfolio of stocks that mirror the composition of the target index. These funds are popular due to their lower expense ratios and the belief that it is difficult for active fund managers to consistently outperform the market. International funds. International equity funds invest in stocks of companies listed in foreign markets. They provide investors with exposure to global markets and allow them to capitalize on opportunities outside their home country. International funds can focus on specific regions, such as Europe, Asia, or emerging markets, or they can have a global mandate. Investing in equity funds offers several advantages. Diversification. Equity funds invest in a diversified portfolio of stocks, which helps reduce the risk associated with investing in individual stocks. By spreading investments across multiple companies, industries, and regions, Investors can mitigate the impact of any single stock or sector underperforming. Professional management. Equity funds are managed by experienced professionals who have the expertise and resources to research and analyze stocks. They continuously monitor the portfolio and make informed investment decisions based on their analysis, market trends, and the fund's investment objectives. Accessibility. Equity funds provide individual investors with access to the stock market even with limited capital or knowledge. Investors can start with relatively small amounts and benefit from the expertise of professional fund managers. Liquidity. Equity funds are generally liquid investments, allowing investors to buy or sell shares on any business day. This provides flexibility and the ability to quickly convert investments into cash if needed. Long-term growth potential. Equity funds have the potential to deliver attractive long-term returns, particularly if invested in companies with strong growth prospects. Historically, stocks have outperformed other asset classes.